your team. It's a pleasure to be here. So the main area I wanted to speak to you about is in terms of commercial mortgages and specifically financing for multifamily properties, as that's our specialty. So I'll get into, maybe I'll see if I can share my screen here, and let me know if you can, if you guys can see this. Is this coming through?
Yes.
Okay, fantastic. So by way of background here, I've been working in commercial mortgages for about a decade. Placed over $5 billion in mortgages in that time, and I have deep expertise in CMHC multifamily mortgages. I've personally been involved in over 120 MLI select mortgages. So, which is really going to be our topic for today, is CMHC's MLI select program. You may have heard about it. It's a very popular financing program for CMHC for multifamily properties. So I'll get into that. I'm based in Calgary. I actually had the Vancouver number here. I'll add my Calgary one, but I'm actually in Canmore at the moment. And apologies for not being there in person. Actually, I'm a little under the weather, so didn't want to be there in person and get anyone else sick. Anyway, in terms of commercial real estate, just by way of a broad overview, where we come in compared to a residential mortgage broker or residential mortgages is on the multifamily side. Once you have 5 or more units, is typically the cutoff. Sometimes outside of CMHC, you can do 4 units with a commercial mortgage, but typically 5 or more units is where a multifamily property, where property becomes multifamily or commercial. And then, of course, other commercial asset classes are things like retail plazas, office buildings, industrial buildings, and then hospitality like hotels and resorts, seniors' homes. We finance land, mobile home parks, self-storage, and there's a few others as well. But this is just an overview of what is considered commercial real estate asset classes. And then there's really 3 types of loans. There's construction loans, when you're building from the ground up. There's a bridge loan where you're maybe buying an asset that doesn't have any income in it yet, or the income is much below its potential. And then a term loan, which is a standard income producing asset, essentially, which is really going to be the focus that I'll have with you today, is on the term side. These are also known as permanent mortgages as well. Then geographically, we cover essentially the whole country. In Quebec, we do it with a partnership, but everywhere else, we're able to work directly. So, brief overview on myself. Out of the 120 or so CMHC MLI Select mortgages that we've done, 61 have been purchases, 39 have been refinances, and 21 have been construction. Now, by way of an overview, I want to discuss what CMHC's multifamily division looks like. So, on the residential side, people might be familiar with CMHC providing financing for up to 95% leverage for first-time home buyers. On the multifamily side, CMHC's had a multifamily division for many decades. On the residential side, you actually have 3 insurance companies. You have CMHC, I think you have Genworth and Canada Guarantee. On the multifamily side, it's only CMHC. And what it does is there's definitely a much lower interest rate that you can get, significantly lower, anywhere from 1 to 1.5% lower interest rate for using CMHC versus not. So it's a very significant difference there. And then there's a lot of additional incentives available. And in general, historically, CMHC used to provide up to 85% loan to value and up to 40-year amortizations. Now, in March of 2022, CMHC launched this program called the MLI Select, which they launched because they wanted to achieve certain social outcomes, specifically affordability, energy efficiency, and accessibility. And so those are the 3 social outcomes that was being targeted by CMHC. And in return for a borrower providing these outcomes, CMHC was willing to increase the the benefits to the borrower with the financing quite significantly. So I'll get into what those are. So one of those is they're now providing up to 95% loan to value on multifamily buildings. And that's gone up from 85% they used to provide, or that they're typically providing. They used to provide 40 years. Now they can provide up to 50-year amortizations. As I was mentioning, interest rates are lower, and they're a touch lower even so with MLI Select versus standard CMHC. 5 or more units. And then there's those 3 social outcomes I mentioned, and I'll get into what those are. And then there's different building types. So, you have your standard apartment building, standard rental, but then this also covers retirement homes as well. There is what's called single room occupancy. So if someone's renting individual rooms, but just for reference, they are pretty strict about this in terms of having significant experience with this type of asset class if you're doing it. There's supportive housing as well, and there's student housing. So there's different types of what they call shelter models within multifamily. And then the purposes can be to build ground up new multifamily. You can use it to buy, you can use purchase financing to buy an apartment building. You can use this to refinance an existing apartment building. You can even use this to convert non-residential buildings to residential. So a very popular one in Calgary right now is office buildings being converted to apartment buildings. The CMHC program can support that. We've also seen some motels and some hotels converted into multifamily. This was actually quite popular during COVID, but the hospitality sector has since recovered, so a little bit less popular in some, depending on the area. And you can also use it for renovations or improvements to multifamily housing. So this is sort of an overview of what you can use the program for. A few other things I'll say is, for retirement homes, you need to have a minimum of 50 units or 50 beds. So it's a little bit of a larger requirement. They don't really do smaller retirement homes. And then sometimes you can have apartment buildings that have some commercial space. So for example, if you have an apartment building and there's maybe a retail podium, and then there's multifamily above, sometimes you see those kinds of buildings, they're okay. The key thing for CMHC is that you can't have more than 30% of the total square footage being non-residential. So it can be retail or office or industrial. You can't have more than 30% of the square footage. There is a distinction.
I mute, Nadeen, I mute you. Everybody
Perfect.
can unmute.
Okay, perfect. Yeah, I think I was muted for a second. I'm good now. So there's a small distinction between, by the way, can everyone see the screen? Is everything coming through okay?
Yes.
Okay, perfect. Yeah, so there's a small distinction between existing buildings and new buildings as well. So that's one thing I want to flag as well. So if someone's buying a new building that's newly built, there's actually some advantages to them because CMHC is trying to encourage new construction of new multifamily properties. So I'll get into why that matters to be whether it's new or existing. Sometimes as well, another advantage of new construction is that you may not need to have the entire building leased up if it's new before the financing comes into play. So those are a few things I'll mention there. Now let's get into the 3 social outcomes I was referring to earlier in terms of what CMHC is looking for to provide this program. One of which is affordability, and they define that as the percentage of units in a building that are at or below 30% of the median renter income for that city. So I'll get into what some of those are. I have a slide a bit later that talks about what some of those what's considered affordable varies by city. I'll get into some of those. And then they also look at energy efficiency. You can also do energy efficiency, and this means how much have you improved the energy consumption and the greenhouse gas emissions from a building. This is for an existing building, or for a new building, it's how much better did you build the building compared to the building code requirements, the national building code requirements. And then accessibility, this is how many units in the building are considered accessible, handicap accessible, essentially, I can describe it as. So those are the three social outcomes that CMHC looks for, and in return, they're giving you these benefits. And depending on how much of this you're doing, it results in different levels of benefit. So the more you do of these social outcomes, the better the outcomes you can get are. So I'll get into the affordability, and I'll pause for questions at certain points. So, you know, if people have questions, do hang on to them and I will take questions. So for affordable housing, I would say there's three levels of benefits that you can get for affordability. One of this is for an existing property. So one of which is if you have 40% of the units being designated as affordable, then you can get 50 points. If you designate 60% of the units in the building as affordable, you get 70 points, and 80% you get 100 points. And I'll get into a little bit more of how that's defined. But I just want to just leave you with, for now, the percentages. And then for new construction, I want to show you as well that the percentage of units that have to be affordable in the building, if it's considered new, is much lower. 50 points. For 50 points, you only need 10% of the units. For 70 points, only 15% of the units. And to get 100 points, which is the maximum number of points in the program, you really only need 25% of the units to be affordable. The other things I will say here is that, you know, you have to agree to commit to 10 years of affordability, meaning that you designate the units as affordable, meaning in Alberta, that basically means you're agreeing to a rent control for those units. You can't increase the units by the market increase if a tenant leaves. You can only increase the units that are designated affordable by what inflation is, which right now is actually quite high for Alberta at 10%, but historically it's been much lower, 2 or 3%. So remember, what CMHC is saying is basically you have to have the units at a certain rent level at the start, and they have to be below that. And then after that, for the next 10 years, you can't increase the rents on those units by more than inflation for Alberta. And then for other provinces, you can't increase the rents by more than what the rent control requirement is for that province. And so this is kind of a bit of a map to show what is considered affordable. It varies by city and by region. And in Calgary here, you can see $1,737 is what's considered affordable in Calgary. So, you know, those percentages I was showing for an existing building, 40, 60, or 80% of the units in the building, or for new construction, 10, 15, or 25% of the units in the building, that percentage of units need to be in Calgary at or below $1,737 to be considered affordable in the first place for a loan to be allowed to fund. And then after that, then you can increase the rents on those units by what inflation allows you to, whatever the inflation number is for rental housing in Alberta. So that's how affordability works as a social outcome. And then I'll get into energy efficiency and accessibility. And then I'll get into to what it means in terms of, depending on how much of those things you do, it'll result in different levels of points. So I just want to pause here and make sure that this is coming through okay, and see if there's any questions that anyone has so far.
You mean we can jump in for question?
Yeah, I want to see if there's any questions so far, and make sure this is landing okay before I keep going.
Yes, cool. Yeah, I have a question first. When you talk about new building will be more benefits, so what's the definition for new? Like 5 years, 2 years?
Yeah, it's a good question. I'll share my screen again, and see if I can get to that point for you. So basically, here. So basically, what is considered new is a property that has not yet achieved 12 consecutive months of stabilized income, and a property that has received its occupancy permit. So you get an occupancy permit when the building is finished. So it has to be less than 2 years from when it's received an occupancy permit, and it can't have been fully leased out for more than 12 months. That's what's considered new. Once it's been fully leased for 12 months, it's not new. And then even if it's not been leased for 12 months, but it's been 2 years after it's been finished, it's also not considered new.
Okay, so if a buyer, sorry, I continue.
Yeah,
If a
please.
buyer purchase during the construction, like before finish, can they starting with a MLI program?
Yeah, absolutely. And we do that quite often where somebody is buying a project while it's under construction. Basically, what we do is we set up the financing, and then by the time that the building is ready, the financing is set up, and they can close on that purchase with MLI Select. And what's really nice as well is that the program also doesn't require you to lease up the building as well when you buy, if it's a new building. So yes, buyers can do that, can buy a building while it's under construction.
Okay. The third question is, if they purchase a land first, then they have to pay higher down payment. But if they want to try the MLI program, can they like sell the land from, for example, from company to personal or from personal to company? Then they can do 5% altogether with the construction costs. Can they do that?
Yes, they can. So basically, this program allows you to. I should say it this way: this financing, the first advance of a construction loan can only happen once construction has started. So yes, someone can transfer land from personal name to corporate name, but then the loan can only fund once construction has started. So CMHC is very against giving any loans that would be considered a land loan. So that's the key point there. But yes, I agree. Buying land, you need to put more down payment, but if you can transfer it, you have all your permits and start construction before the loan funds, you can do it.
Okay, so that CMHC loan will combine land value and construction costs together.
Yes, it's maximum of 95% of land and construction costs together. Correct.
Okay, so are there any other people want to ask question? I'm done of
Yeah.
I think Kathy has a question. Yeah, go ahead, Kathy.
Yeah, thank you. So I missed the part that why you said new property is better for CMHC program.
Yeah, so a new property is better for the CMHC program because of how CMHC provides the social outcomes. And I'm actually yeah, I think I can actually. You know what? Let me continue on this. I'll answer your question, Kathy, as I continue here. So when I was showing the different point levels for the different social outcomes, and I think what I want to show you here is that for existing properties, or hang on, let me get the right slide for you here. Here, okay, this is a good way to look at it. So for new construction, you only need to have 25% of your units as affordable to get 100 points. Whereas for existing housing, you need to have 80% of the units as affordable to get 100 points. So it's actually, this is why new construction is better, is because you don't have to have as many units as affordable, which is a big advantage between new construction and existing properties. And I'll get into sort of like a bit of an overview as well here, which is, when you look at existing properties, when I was talking about the different point levels, this is based on how many points you get. The more points you get, meaning the more units you have as affordable, or the more energy efficiency or accessibility you do, the better the benefits. You see, if you only get 50 points for an existing building, you can only get up to 85% loan to value. But if you get 70 or 100 points, then that can increase to 95%. The same thing, the CMHC premiums that get added to the mortgage, similar to a homeowner, first-time homeowner mortgage. CMHC adds premiums to the mortgage. It's a type of mortgage insurance, essentially. The premiums actually decrease as the points go up because they're trying to encourage people to get more points, to give more affordability and energy and accessibility. The other thing I want to mention as well is that there's, that these leverages of loan to value of 85 and 95, they're not guaranteed. They are also constrained by what's called the debt service ratio, which means it's the income from the building compared to the mortgage payment. And the ratio that they're allowing for is 1.1, which is actually a very, very good ratio for borrowers. But it means you have to have $110 of income from the property for every $100 of mortgage payment. That's how you get to a 1.1. So sometimes if the property does not have the income is not as good, or for a new building, the projected income is not as strong, then the loan to value might come down because the loan is limited by the debt service ratio. So that's one thing I do want to convey. And then as well, the amortization, as you get more points, the amortization increases. Up to 50 years, you only get when you have 100 points. And so those, I would say those are the main benefits. And then with new construction, it's similar. The premiums are slightly higher for new construction compared to existing. For 100 points, new construction is 2.8% premium. Here it's 2.55 for existing, so it's slightly higher. And then the leverage is based on loan to cost, not loan to value, because it's a construction loan. And to one of Vivian's earlier questions, it's based on the cost of the land and the construction cost. And when it comes to land, you can actually use the value of the land. Even if you purchased it for a low price, if the land is appraised for a higher value after you've closed on it, you can use the higher land value as part of your total budget. Then you can get up to 95% of the combined budget with land and construction cost. Amortization increases, as I was saying, same thing. Like I was saying, this rental achievement waive basically means if it's a new building, you don't have to have it leased up before the loan can fund, which is very unusual for a commercial mortgage. And then I'll get into some of the energy efficiency. So we'll finish off the other social outcomes here, which is energy efficiency. So for existing properties, energy efficiency means you have to reduce or improve the energy efficiency compared to the way it is right now. So for example, if somebody's buying an apartment building, CMHC says, okay, either if you've done these improvements in the last 12 months, or you agree to do it in the next 2 years. So they'll still fund you the mortgage and you promise that you'll do it over the next 2 years, then they can give you that. And depending on how much you agree to do, 15% improvement, 25% or 40%, you can get points for energy efficiency as well. And you have to work with an energy auditor who goes in, who looks at the mechanical and structural components of the building. They look at the boiler, the hot water tank, the insulation, the lighting, the plumbing fixtures, and they can say, okay, we can get LED lighting, we can get low flow plumbing fixtures, we can get a programmable thermostat, we can get better insulation, we can get more efficient heating and water. And that's what allows you to improve the energy efficiency of the building. So that's how you can get energy efficiency. And then for new construction, the way new construction works, it means how it was built compared to what was required. So if the building code required a certain level of insulation, but you did triple pane windows, or you did extra insulation, or you did LED lighting, or you did these things that you may not have been required to do, then that's how you get the benefits for energy efficiency. So that's what I was saying here. Based on a percentage decrease in energy consumption, they must be evaluated and confirmed by an energy auditor, and it's either in the last 12 months or the next 24 months. So that's energy efficiency. And then accessibility is the last one. Now this one, you can't get as many points for accessibility. It's 20 or 30 points, but it's basically 15% of the units are considered accessible. So handicap accessible, you need to have 15% of the units in the building. There's also what's called universal design, which means it can work for different stages. You work for different different needs, I suppose you can say. And the key thing for accessibility is that one of the best ways to get points for this is what's called Rick Hansen certification. And when you can get that, it's a third-party company that can give you points based on, do you have ramp accessibility into the building? Do you have wide corridors? Do you have a wide hallway within the unit so a wheelchair can get in? Do you have the ability to step into a tub without having to go step on top of the tub? Like there's things like that allow you to get accessibility points. But by itself, accessibility is not enough. Accessibility you have to combine with other social outcomes. So speaking of combination, for example, you can get 50 points for affordability, and you can get 30 points for energy efficiency and 20 points for accessibility. And you can combine all those three to get 100 points and get the most benefits. Or you can just choose affordability and get 100 points with just affordability. You can mix and match. So those are the social outcomes. Those are some of the benefits. Maybe I'll pause here again and just see if anybody has questions. Otherwise, I'll get into how do you qualify for this, and how does qualification work, and what information do you need, to sort of the next few things. But and I'll also get into interest rates. But I'll pause here again and see if anybody else has questions. Caroline.
I have a question.
Yeah, go ahead.
Caroline, go ahead. Go ahead.
Oh, okay. Thank you. I was regarding before, like, here's the scenario. For example, a builder has purchased this land and they started construction, and they applied for CMHC for construction part. And then they decided, when close to the finish of the completion of the construction, they decided to sell the whole project to a buyer. And then the buyer would like to apply for CMHC for operating the whole multifamily project. Is the CMHC going to approve this kind of, because they're using basically the same piece of land, same project, but it's applicant would be different group of people.
Yeah, and we've done that before. So it sounds like you're saying, would the buyer in this case, Caroline, be buying
eligible?
Would the buyer be buying a partially completed project, and would the buyer be finishing it, or they'll just be buying the completed project?
The completed project.
Yeah. So did the seller use CMHC financing to build it, or they use different financing? Do you know?
The seller would be the builder or the developer. They apply for CMHC to fund the construction.
Got it. Okay. So in that case, it's a really good question, because if a seller, so let's say the builder used CMHC financing to build the building, and now a buyer wants to buy it, CMHC actually allows for that. And what they allow for is called an assumption of the mortgage. So the buyer can assume the mortgage. So they would assume the mortgage amount. They would also have to assume the social outcomes associated with that mortgage. So if the mortgage that the builder got said you've got to have this many units as affordable, the buyer has to take on that obligation as well. So it is possible to assume a CMHC mortgage. One thing to think about, though, is that CMHC is now saying the process is called a replacement of covenant, and a covenant basically means a guarantee. And so CMHC allows for that to be replaced. So the builder's guarantee will be replaced by the buyer's guarantee. But CMHC's rule is that the buyer's guarantee has to be the same or stronger than the seller. So if it's a very big builder developer that has a very strong guarantee, and the buyer doesn't, their qualification is not as strong, they may not be able to assume it. But there's a solution there we recently had where basically you have the seller can stay on with the guarantee for a certain period of time. Usually it's a minimum 5 years, and then the buyer can reapply for a new loan, and then the seller's guarantee can come off. So there are some solutions, but there is a way to do it.
Okay, thank you so much.
You're welcome. Kathy?
I think Rachel had a question before me.
Sure. Rachel?
Oh, okay. Hi, Nadeen. I have two questions. One, I just remember you show us the premium compared to the existing and new construction. I want to I want to say if that's premium, okay, so if, yeah, this one. So this premium, is that affected with the interest rate, where we go as the premium changes, where you have different qualification of points? Is that changes?
So your question is, does the premium change based on the number of points?
The interest rate, is that affecting the interest?
I think Rachel mean prime rate change.
Okay. So does the interest rate affect the premiums that are being
Yes.
charged? No,
Yeah.
it doesn't. It's completely separate from interest rates. So regardless of the interest rates that you have in the market, and I'll get into what they would be for something like this, but regardless of the interest rates, your premiums are only based on the number of points that you get.
Okay, I see. Okay, the second question is, you just mentioned that for the new construction, you could applying where you have to combine with the land value and the like see your blueprint estimate value of the whole project, right?
Correct. Correct.
So is that has to start it before the can we start this before the land purchase, or have to get the blueprint actually in hands, or even get a BP issued?
Yeah, it's a very good question. Thank you for asking it. Yes, you do have to. CMHC's standard position is they want the development permit, the DP, to be approved prior to submitting for
Okay, I
CMHC.
see.
However, they can make an exception if a DP has been applied for and you're just waiting for a few weeks. The city and the different departments have agreed to it. The architect can write a letter to say, here's when we expect the approval and we expect it to come in the same way that it was applied or on this basis. They can make an exception, but generally need to have a development permit in hand before applying.
Okay, that's a good question. So if we're looking at the land which has a existing building, like say a rental house on that already, but in the meantime, before you demolish this building and starting to dig a hole on the ground, you actually can apply for the BP and start the CMHC application as well, right?
Yes, exactly right. Yes.
That's all I want to know.
Perfect. Kathy?
Yes, great. I actually have 4 questions. I'm gonna stay online.
Yeah,
Gonna do one
go
by
ahead.
one. So first, the amortization. Like I see in your chart with new building, it can be up to 50 years, right? Of
Mhm.
course, the older building seems to be lower. I guess there will be appraisal process to see what's the remaining life expectancy of the building. and it will be
Exactly
labeled
right.
like that. Okay.
Yeah, exactly
Okay.
right. So that can come from an appraisal or an inspection. But I would say we've financed older buildings like 1960s, 1970s buildings. If they're in good shape, we've had appraisers that have supported a 50-year remaining life of the building. And if there's a 50-year remaining life, then you can get 50-year amortization.
Perfect. Second question. So if the buyers are buying a place, applying for CMHC, how long does the approval process take? Because I have heard it can take like 2 to 3 months.
Yeah, so last year it used to take we had 6 or 7 months because CMHC announced they were increasing the premiums last summer. Everybody was applying, it got very backlogged. Right now, it's actually a really good time. Right now it's taking about 4 to 6 weeks to actually get the approval from when you apply. So it's the fastest it's been in a very long time.
Wow. So we don't have to have a 4 months condition.
Yeah, I
Okay.
would say so in terms of time, I'll see if I have a timeline slide here. But yeah, maybe I don't have that anymore. But I would say typically I would suggest you get before you apply, if it's less than 24 units, you need an appraisal. The borrower needs to collect the information. The appraisal a commercial appraisal can take 2 to 3 weeks. So you get a plan for that. So call it 2 to 3 weeks before you can apply, and then you can take 4 to 6 weeks for CMHC to approve it. And then it might take another depending on the loan size and the type of loan, it might take another 2 or 3 weeks for the lender to approve it, and then another 3-4 weeks for it to fund. So you still need to build in a few months in terms of closing, but the condition period, maybe it's 4 weeks plus 6 weeks, maybe it's 10 weeks. Because remember, like before you get the approval, there's quite a few steps that still have to happen. You still have to collect quite a bit of information.
I see. So still at least minimum will be 2 months condition period. And then
Yes.
maybe leave another at least like 2 to 3 months for closing. Right?
Yeah, I would say leave another 2 months for closing.
Okay.
Yeah,
Okay.
one and a half to 2 months.
Yeah, so
Mhm.
third question, I just
Mhm.
want to make sure we are able to touch on the seed program later in the presentation, right?
I don't have it, but we can definitely touch on it. We can.
Okay. Yeah, and then the last question is, so the upfront cost for clients, let's say even before, like they submit application, they don't know whether they will get approved or not. I will assume it's the appraisal cost. Like I heard you need to do the environmental as well. So like $3,000-4,000 upfront cost before they know whether they will get approved.
Yeah, really good question. Yes, so I would say the appraisal is required to get approval from CMHC. The environmental, we don't need until later on in the process. But a commercial appraisal is typically 2,000 to 3,000, and an environmental report eventually, when you want to get it, is another 2,000 to 3,000. So you potentially $4,000 to $6,000, in terms of third-party reports. And you may also want to get a building condition assessment as well. If it's an existing building, that's also another 2,000 to 3,000. So there's definitely some third-party reports that are required.
Okay. I also heard there are people who got this CMHC affordable housing certificate, but they have a hard time finding a lender who will fund because lender gets very picky and say like, hey, 5 million or lower, I don't even want to fund. Have you run into that?
100%. It's a very good question. Right now, I would say because it's such a popular program, lenders are so busy and the bigger deals are more profitable for them. The smaller deals are more challenging. So, but so far, knock on wood, we've had no issues. Like we've funded construction deals that are $1.5 million. We've funded existing buildings that are $1 million. Like it's definitely harder, but they're still getting done, or at least we're still getting them done right now.
Okay, great. Yeah, thank you so much.
No problem. Great questions from everybody. Who is next? I think Caroline Fang.
Fang
maybe-
Wang.
Yeah, go
Yes.
ahead.
Hi, Nadeen. Thank you. I just have a quick question to clarify Caroline's question. So for regarding the CMHC mortgage policy is not friendly to transfer it to the buyer, right?
I mean, it's possible, but you have to.
Yeah.
There's a few steps you have to take.
They need to reapply it, right? If they qualify, but not transferable, right?
Yeah, it is transferable, but you have to qualify you can transfer the loan approval, but the new buyer still has to qualify, and they have to qualify, and they have to be the same or better financial strength as the seller.
Okay, thank you. So, can you please share the PPT after the meeting?
Yes, I will. I'll send it to Vivian and she'll send it out.
Okay, thank you.
No problem. Yeah, go ahead. I think whoever was next.
Okay, everybody, I got new question. One is a foreign buyer, because foreign buyer can buy commercial and building and land. So for they to apply, they're all apply to the same rule or different?
Yeah, so really good question. So foreign buyers are allowed. So actually, I'm dealing with somebody there's a couple of people, but we're dealing with somebody right now that's based out of Hong Kong. He's a Canadian citizen, but he's living in Hong Kong and he has some Canadian assets. So CMHC is allowing for that because to qualify, and I'll get into qualification, you have to have net worth in Canada. So you have primarily real estate or investments in Canada to qualify. If you don't have that in Canada, then you can get what's called non-recourse, which means no guarantees, but the leverage there is 65% loan to value or less. So it just depends if you have assets in Canada and if you have residency in Canada, you can get the fuller benefits, but if not, then you're limited to 65% loan to value.
Okay, and another thing, you when Rachel asking about the rate, you say it won't change, but I kind of remember you mentioned to me before it's prime. Based on prime, deducts the 1 or 1,
Yes.
1 So it
Yes.
will change. It's not, or it won't change.
Yeah, so I understood the question would be, will the premiums change if the interest rate changes? And that's where I said, no, the premiums won't change. But I can get into, why don't I get into a couple of questions? If we can hold a few of the questions, I'll get into a few of the sections because I'm going to get into qualification because it touches on your question about qualifying. And I want to touch on interest rates because it'll answer that question as well, Nadeen, if that's okay.
Sure. And remind everybody after you ask question, lower your hand so we know it's a new.
All right. Okay, so yeah, so this I'll show you just as like a comparison between conventional, which means non-CMHC commercial mortgages, and then the MLI Select that we're talking about. Or sorry, the MLI Standard, which is standard CMHC financing, still available. This was in place before MLI Select, and then MLI Select. So standard commercial mortgages between 75 to 80%. It's typically 75% is the limit, but apartment buildings, you can get up to 80%. Typically, CMHC would provide up to 85%, and MLI Select is 95% leverage. The amortization typically for non-CMHC commercial mortgages is 25 years. Sometimes they make an amortization exception for 30 years based on a newer multifamily building typically. Standard CMHC used to be 40-year amortization, and now you can get up to 50. Qualification is based on the cash flow of the property and the net worth of the sponsor. And I'll get into that. And I'll get into the net worth requirements in more detail, but as a preview, you need to have a net worth of 25% of the loan amount for CMHC multifamily mortgages. And a net worth basically means all the assets you own in Canada, the cash, investments, stocks, bonds, mutual funds, all of that, the equity you have in your real estate. So all of that minus all your liabilities. So all your lines of credits that are used, all the loans that are used, all the mortgages. The difference between the two is your net worth. It basically means the equity you have. Your personal income is very, very unimportant, very not important here. It's about the net worth because a lot of the sponsors here don't tend to hold a day job. They tend to hold assets. They tend to be investors. So the income, personal income, is really not very relevant here. The other thing I will add is that when it comes to commercial mortgage, when it comes to construction, for construction mortgages, the requirement is more stringent. You need to have a little bit more net worth. So I'll get into that in a little bit more detail. The debt service ratio, this is what I was talking about. You're not guaranteed to get these leverages. 1.25 is what is typical for typical mortgages. And remember, you have a 25-year amortization, which means the mortgage payment is higher. When you increase your amortization, your mortgage payment comes down. And so it's actually, the 1.1 is actually much lower, and you have a high amortization that reduces your mortgage payment. So this is why MLI Select is so popular, is because amortization is so high, it reduces your mortgage payment, and you have a really low debt service ratio. So this is why it's really popular. But let me get into the qualifications. So in more detail, you need to have a minimum of 100,000 net worth and at least 25% loan to net worth. Now, certain assets like cars, you can't count your cars, whether they have car loans or not. You can't count, CMHC doesn't count them. Same thing if you have RSPs, RESPs. If you had to cash them out, you'd have to pay some penalties and some taxes. So CMHC discounts them by 50%. So there's some calculations you have to do there. As I was mentioning as well, and this net worth requirement is a combined net worth. So if you have multiple partners, you can add up everyone's net worth to qualify. If it's construction, the requirement is more strict because there's more risk during construction. And I would say typically 50% of the loan amount. Also during construction, you also included in your net worth, you need to have some liquidity, meaning cash or investments that can be converted into cash relatively quickly. And CMHC looks for 10% of your hard and soft costs. So not 10% of your, doesn't include land, but just of your construction costs, they want 10% of that relatively liquid, meaning it's, stocks, bonds, GICs, cash, that you can convert to cash soon, so that if there's a delay in the project or an overrun in the cost, that CMHC sees you can fix that. If it's an existing building, there's less risk. They're less fussed about how much cash you have. Credit scores, I would say 650 or more is a requirement. It doesn't make a big difference if you're 800 or 700. It just, you need to, can't be a bad one if you can't have previous recent bankruptcy. If you don't have 5 years of property management experience, you can't be allowed to manage your own building. CMHC will require you to hire a third-party property manager. If you're a building, you either have to have some experience yourself, or your builder has to have the experience building it. You know, I talked about an appraisal being required for 24 units. I would generally recommend it for all units. And then I think there was a question as well, there's a good question about environmental reports, which you need for any property more than 7 or more units. This just shows if there's contamination on the property or not. So this is how people qualify. And then the process, in terms of the documents you need, so information on the property, this would be for an existing building, this would be like your rent roll, what are the rents, and your operating statement. If it's a construction project, it would be your construction budget and your drawings. Then you would need to have the borrower information. So this is, what is the company that's going to hold the property? What is the owner? What are the shares and the shareholders? What is their experience? And then, you know, we pull up credit scores and their net worth as well. And then the third-party reports that we've talked about a few times. Then we prepare a loan application and we submit it to CMHC. You know, we're a brokerage out there. You don't have to use us, but if you use a brokerage, really important to make sure that this is a brokerage that can submit directly to CMHC like we can. There are many brokerages, residential mortgage brokers or mortgage brokers that will work with the lender to submit the application, and in doing so, you have less control and less choice, and it's not adding as much value for you. So make sure it's a broker that's experienced in commercial and can negotiate directly with CMHC. The CMHC approval is called a certificate of insurance. This is when CMHC approves your loan. Another excellent question that was there is that even when you have that, you have a very strong likelihood of getting funded, but you're not guaranteed. You still have to get a lender on board. And that's where this is the lender, I would say, I'll call this a lender commitment, where, you know, you get quotes from lenders, they offer you terms, and then once you choose a lender, you get approved, you get a lender commitment letter. Then after you get a commitment letter, then you're funding the deal. So it's a bit of a process. Like I said, this is, I would say, you know, you give it about 3 weeks to gather all this information, 4 to 6 weeks to get this. So now you're at about, you know, call it 10 weeks, and then, you know, you want to give it another a month, give it a month to fund, and a few more weeks for approval. So you're sort of looking at a 3 to 4 month process. Now, if you're looking at an existing building that you're selling, or you're listing, or you have a buyer that's buying, this is typically what we can use to get preliminary analysis. It's a purchase contract. If it's construction, you know, what is the land? What is your budget? What is the current or projected rent or revenue? And then the key expenses, if for an existing building, is property tax, insurance, and utilities, or you can just get an operating statement. If it's a new building, this is something that we can project together working with an appraiser. And then, of course, I talked about the personal net worth, and we can send a personal net worth form out as well, if that would be of help. So next thing I'll get into is interest rates, but maybe I'll just pause here again and see if there's any other questions so far in terms of qualification or anything else along the way. Go ahead, Vivian.
Okay, that's actually previous one I forgot to ask. When you mentioned the rent, Calgary, how much? 1,700.
Yeah, 1,730.
37. So yeah. So I heard that's doesn't matter you are 1 bedroom, studio, 2 bedroom, you all rent at this price, or?
Yeah, that's an excellent point I forgot to mention. Is it doesn't matter the unit type you have. Even if your building is all studios, or you can choose what unit type you can use to meet these. So oftentimes when we do projects with townhomes with basement suites, the basement suites will be below that, or if there's enough 1 bedrooms or studios in the building, 2 bedrooms even, you can get there. So the unit size does not matter to CMHC.
So, for example, if it's only a studio, and if we rent it for 1,737, that's actually higher than the market rent, and we use. Can we call that affordable housing?
Yeah, technically you can. I mean, for sure. The only consider. I know it's crazy. I don't know why CMHC did this. To be honest,
Yeah.
I think they might fix this in future. But the
Mhm.
the only consideration I would say there, Vivian, is that as long as the rent, if the market rent for the studio is 1,700, that's fine. But if the market rent is 1,400, but we rent it for 1,700, appraiser has to agree to it, and CMHC has to agree that the rent is market. So that's the only thing I would say is it doesn't matter what unit type, as long as the rent is at or below market rent.
So this median rent, do they change every year? Because last time when I saw the number is 16, is first is 1,500, then 1,650. Now you show 1,737.
Yeah, it actually hasn't changed in a while.
Oh,
So
okay.
so it hasn't changed in a while. It may change. I think I'm hearing this year it might change. And if anything, it's actually going to go up because incomes are going up. But
Mhm.
for now, these are the numbers. They haven't changed in about 2 years.
Oh, that's quite high. So we can rent a basement 1 bedroom for this rent.
Yeah,
That need to agree. Yeah. Okay.
yeah, exactly. Rachel? Oh, sorry, Vivian, if you have any other questions?
Another one. I put two, but I forgot where I put it. Okay, yeah, you mentioned the appraisal under 24 units. Then what happens if it's above 25 units?
So you don't require an appraisal if it's more than 25 units. We can actually do our own valuation. CMHC does their own. I usually recommend it. So if it's in Calgary, we may be okay without it. I usually recommend it because we can get our own appraisal. We can choose the appraiser. We can have a discussion with them about valuation. I find it's usually beneficial to our valuation and our loan amount to get an appraisal, even if it's larger. But the benefit I find actually is that we can apply faster if it's more than 24 units. So we may not need the appraisal to apply. We can apply, but then by the time CMHC is looking at the file, I like if we have an appraisal on hand because it helps us negotiate for a higher loan amount.
Okay, thank you.
No problem. Rachel?
Oh yeah, when I saw this map, I just there was a question before, but I forgot to mention until I saw this map. So is this MIL, what it's called, the program? Is that applying for the properties all along nationwide, like within all Canada, or only in Alberta, BC, or some a certain province?
Yeah, so it's everywhere in Canada actually. It's everywhere in Canada that you can
The
use this program.
qualification will be
But-
all the same.
So the rents are, yes, the qualification is all the same. The rent is different. So I'm just showing the major cities. If you were in Red Deer, for example, Red Deer has their own median renter income. We didn't put it on this map, but I'll pull it up, and one of the things that we'll send to you is the median rent for all the cities that are listed in Canada. And in fact, I think I even have it here.
I didn't
Median
see any
renter income.
city in Saskatchewan.
What's that, sorry?
I didn't see any major city in Saskatchewan. Maybe I missed it.
No, yeah, I think we didn't put it in there by accident, but yeah, I'll pull it up and I'll show you.
Okay.
And well, in fact, I'll send it out. Basically, it'll have a list of all the cities, and for very small cities that are not listed, what you can do is there's a rural median renter income that's actually shown, and for those, if it's a small rural center, CMHC uses the median renter income for the rural center. So that's what you would have to use in those cases.
So I guess every city in the this program, CMHC has definition for that median rent in that certain area, right?
Correct. So I'll show you. I'll show you an example. I'll see if I can share my screen here because it's an important question. Bear with me here. Okay, so I'll make sure this gets sent to you. But basically, these are the median renter incomes that we have that CMHC has listed. So Calgary 69,500, and
But that's annual.
Exactly, that's annual. So first thing you do is divide it by 12. Then the
Yes.
next thing you do is they're saying it has to be 30%. So you take 30% of that number, and that's how you get 1,737.50.
Oh, I see.
And so we have this basically for every city in the country, but for the cities that are not listed, then what you do is, like, let's say it's a small center in Alberta that you haven't heard of, or that's not listed. You basically would have to take the rural Alberta, which is actually 1,132.50. So it's a bit lower, but that's what you would have to do in situations like that. So it's a great question. I'll send this to you as well.
Yes, please. Thank you so much.
I'm very surprised we are higher than Vancouver.
Yeah, it's very interesting. Median incomes are actually higher in Calgary than they are in Vancouver. And what's really actually interesting too is that the rents in Vancouver are even higher, and so it actually becomes very difficult to actually achieve affordability in places like Vancouver and Toronto, because the incomes are lower and the rents are higher. So it's more difficult for those provinces. We're actually quite fortunate in Alberta that our incomes are high and our rents are not as high as some of the other cities. So for affordability, it's easier to qualify in Alberta. What happens in those other provinces and those other big cities is that people tend to qualify for energy efficiency more commonly in those provinces. I know we're at our time, and I think we pretty much covered everything. I'll maybe spend a couple of quick minutes on interest rates, and then that was really it for the formal part of the presentation, if I may.
Sure.
Can you see my screen?
Yes. Yeah,
okay, perfect.
We don't set the ending time. You can take as long as time.
Yeah, okay, sure.
Right.
I mean, I've built in some extra time, so I can keep going, no problem. We'll answer more questions as well. So interest rate wise, I mean, I went into quite a bit of detail here in terms of how interest rates are calculated on the commercial side. Maybe I'll just focus on the indicative interest rates. This is as of March 1st. It hasn't changed too much, but essentially, I'll send you a link to our website, and what we have on our website is we put in like what's called the bond yields, which means like it changes daily in terms of what the interest rates are. And what you have to do to calculate interest rates is you have to calculate a spread. And so on our website, we're showing the Canada more. So for example, for conventional interest rates, meaning not CMHC, you take the Government of Canada bond yield and you add 1.75 to 2.5, which means that conventional interest rates right now are around between 5.25% and 6% approximately. For CMHC, you take 0.4 to 1.25% over the 5 or 10-year CMB, which is the Canada Mortgage Bond, which essentially means today your interest rates can be anywhere from 4.15 to 5.1%. So as you can tell, CMHC interest rates are significantly lower than non-CMHC interest rates. There's a big savings for doing that. And then in terms of construction, this should say bridge, interim, and construction, that's what's floating over prime if you're doing a construction mortgage. And that's anywhere from prime plus 1.5 to prime plus 4. That's for a non-CMHC interest rate. I would say for CMHC interest rates, it's actually anywhere from prime minus 0.5 to prime plus 0.5 is typically the interest rate for CMHC construction mortgages. So as you can tell, there's actually quite a bit of savings. So, if you're doing a construction mortgage with CMHC, the prime rate today is 7.2. So you're basically can be anywhere from 6.7% to 7.7% is the typical range for CMHC. Whereas if you were doing non-CMHC construction financing, you'd probably be starting at 8.7%, going to 11%. So there's a savings both in the term interest rate and the construction interest rate. And then, I mean, I've just put some graphs to show what's happened with interest rates over the past year. As you can tell, last March it was really low. In October it was at the peak, and then it's sort of come back down. And I think this is kind of a bit volatile. Where interest rates going to go? You know, everyone's talking about interest rates coming down, and this is the prime rate people are talking about coming down this year. But the bond yields that dictate the fixed rates, they're based on expectations. So if the market expects the prime rate to come down, bond yields are already pricing that in, kind of like a stock. They price in expectations. So if interest rates don't come down as quickly as we expect, those fixed term interest rates could actually stay the same or go up. I'm not saying they will. I don't know where they're going to go. It just depends on what happens with inflation, what happens around the world with geopolitical events, and what happens with the Bank of Canada. But hard to say. I get asked all the time, and I've learned, especially in the last few years, it's a very dangerous game to predict interest rates because everybody's been wrong constantly for the last 4 years. So, you know, I wouldn't bank on interest rates, commercial interest rates falling through the floor necessarily. I think it'll be a bit of a bumpy ride, but I'm hopeful that they will come down. That's the formal part of my presentation. Open to any other questions.
Yeah, I have a question. And about construction loan, CMHC construction loan, when is the first draw from the lender?
Yeah.
Thank
So,
you.
yeah, for sure. So the first draw from the lender would happen once the loan is approved, a lender has been chosen, legals have been done, and some construction work has begun. So if there's a rental property, it's been demolished, or if there's land excavation has started. So if some work has started and the borrower has met their equity requirements, so if they need to have a certain equity requirement, once that's been met, permits are in place, legals are done, lender's done, CMHC is done, and you've done some work, the first draw can happen.
So I heard it happens after foundation. Is that true? Oh, it can be earlier?
It can be earlier.
It just depends on different lenders, their policy.
Yeah, I would say most lenders can do a first draw. It's actually based on CMHC's requirements, and CMHC just says they need to be some construction has started. So I haven't done 120 of them. I haven't had a lender so far say they want a certain stage of construction to have begun before a CMHC construction loan can fund.
Okay, so you mean it can be earlier than foundation starts.
Correct. Yes.
Okay, thank you.
Vivian?
Yes, when you're talking about the rate, it's a prime minus 1 or 1.5 for CMHC program. But most of the time we see on the market is under 4.5%. So is that, I know you mentioned construction loan. So when we buy existing and apply for the MLI program, is that interest will tend to lower?
Yes. So for sure, the interest rate will be lower when you're doing an existing building. So if you're buying an existing building or the building has recently been built, that's when you have the permanent mortgage, and this is where it's CMHC plus the CMB plus between 0.4 to 1.25, which is approximately between 4.15% to 5.1%. That's approximate range right now. During construction, that's where it's prime minus a half to prime plus a half, which would be 6.7 to 7.7 during construction. Once it's built, then you can do a permanent mortgage, which is much lower interest rate.
I saw lots of Edmonton builder. They buy the house, they buy the land, and they kind of put a 5-month position, and they kind of resell to next buyer, and they want to build the property and sell. But they talk about interest rates under is 4.5 to 4.26. So do they do two type of loan? One is building loan, one is after?
Yes. So it's basically the same mortgage.
Mhm.
During construction, it's floating over prime. And then
Okay.
once construction is finished, then you can convert the interest rate from a floating over prime into a permanent interest rate, which is much lower. So it's the same mortgage, but the interest rate changes once it's done. It drops once it's done.
I understand. Okay, anybody else has question or?
I think Rachel.
Okay.
Yes, I still have question. So I heard that the what it says you just mentioned that the small amount like the $1 million building or under even 2 millions challenge to go through this program. Somebody's suggesting that for those multifamilies, you use the conventional mortgage to go buy it. After you have the title and transfer the ownership, then you do a refinance or what is called that go through this program for CMHC. How's your experience on that?
Yeah, so I mean, a couple of things. And are you talking about if someone's doing a construction mortgage, buying a house and then starting the building, or do you just mean
No,
even
existing multifamily?
Yeah, I mean, you can do 2 rounds of financing, you know, you pay somebody like me twice, but to be honest, if you can get a long enough closing period to do CMHC financing off the bat, it tends to be better as long as the building, if an existing building has strong enough income. Because what happens when you do 2 rounds of financing, you have to pay 2 rounds of fees, and you have to pay generally a higher down payment, a higher interest rate, higher fees. But
I totally understand.
where it make sorry, go ahead. No, go ahead.
Technically, the challenge is if it's on sale on the market, they won't allow you to give like 2 months condition for financing. That's the
Yeah.
challenge part. So we've
Yes.
been trying to go through that way, but without even asking, because the market is so hot, right? And those are good potential ones. They won't give you that much time for financing.
Yeah, and that's fair. And if you can't get that amount of time for condition, or even if you can't get that amount of time for closing, so sometimes what we can do in those situations, if the seller doesn't want to give much time for the condition, but they'll give more time for the closing, we can, and if the buyer knows, you know, in the shorter time that they have for the financing condition, we can get a non-CMHC lender to approve it, or at least get some comfort they can get approved. Then they can still close with the CMHC financing, and they can have waived conditions before the CMHC financing comes through, because they know they have the backup. If they can't close with CMHC, then at least they know they can close with some other financing. So,
I see.
But if you can't get a long condition and you can't get a long closing, then you have no choice for sure. You know, you can close with a different round of financing and then refinance it after.
You're right. Yeah, that's the practice we're going through, and it's pretty challenged with if there's another backup offer or something like, you offer the amount that we like it, but the condition they know, sorry, we can't accommodate that longer financing condition day. So that's the challenge part. Okay, that's another question is, see if that's a new company, because this is commercial mortgage, right? You cannot buy just with the regular under personal name. So if there's a partnership with the maybe 2 or 3 or investors wants to make a new joint venture and go through this way to buy, let's see, either existing, or they trying to build on a land went through this program. I guess that just goes to the personal guarantee for that new joint adventure to go through the qualification process.
Yeah, so I will say that most people tend to have a company and they hold shares in it, but it's actually possible to buy it in your personal name, or to buy it in. We've done a few loans where people wanted to buy it in their personal name, and that's possible. And if you buy it in your personal name, you still would qualify personally. If you buy it in the corporation, you know, people tend to be providing personal guarantees and qualifying personally. Hopefully that helps answer that.
This is commercial mortgage. How can you buy under personal name?
It's possible. You can buy it under your personal name with a commercial mortgage.
Oh, really?
Yeah.
I
It
didn't know
depends.
that.
The commercial is only based on zoning, not based on under what kind of name.
Yeah.
Zoning.
So one restriction for the commercial mortgage is that if so with commercial mortgages, sometimes people can do 10-year mortgages. If you buy in your personal name, you can't do more than 5-year terms, so you're limited to 5 years. But we've done, you know, it depends on taxes. So I had a tax person tell me somebody would be crazy to buy in a personal name, and I had somebody else tell me buying your personal name is great. So I'm not a tax person, and that would be the main thing. And the lawyers would also provide some advice. I think I had a lawyer tell me if you separate your personal name from the ownership of the asset, it, you know, it could be better for legal reasons. Again, I'm not a lawyer either. So it really is up to the board, but for financing, we can do both ways. And we have most of the time it's corporations, but some people want to hold personally, and we've done that for them.
Okay, I see. That answers my question. Thank you.
No problem. Any other questions?
So if not, but I would like to remind everybody it's because most of our realtors residential, so they don't aware there's a fee for applying commercial mortgage. So Nadeen, if you can, yeah, if you like, you can share it, or it's your
Yeah, for sure, of course. So with residential mortgage lenders, mortgage brokers, typically they get paid by the lender. In the commercial mortgage world, it's a little bit different. The borrower pays the commercial mortgage broker a fee. But it also, but doing that ensures that the commercial mortgage broker is not biased. I actually think residential mortgage brokers, don't tell them I said this, I think it's a little bit crazy because different lenders will pay different things to the residential mortgage broker. Sometimes they'll get bonuses, they'll get incentives from these lenders. As a commercial mortgage brokerage, we're paid by the borrower, the lender doesn't pay us, and that means that we're unbiased for the borrower. Our fees are typically 1% of the loan amount. We have a minimum fee of about 25,000 for an existing property or 30,000 for construction, but we still take on all loan sizes if that minimum fee is there. And then as the mortgage sizes get larger, once you go above 5 million or 10 million, and as you get more experience, those fees can reduce below 1% of the loan amount. We're paid similar to realtors. We're paid upon success. So some brokerages look for retainers. We're typically paid upon success. So once we're successful in funding, our fee gets paid at the time of closing. It gets deducted from the loan proceeds through the lawyers. Is typically how we get paid. Now, some lenders will allow us to increase the interest rate, and the lender would pay us. It's a transparent process with a borrower. They can choose. If they do that, they end up paying more in the long run because over time they're paying more in interest. But yeah, some lenders, especially with CMHC permanent mortgages, allow us to do that. So different way of getting compensated, but that's how it works. Thank you for asking, Vivi.
Okay, thank you for your time and lots of information. It's really helpful.
My pleasure. Nice. I'll send you, Vivian. I'll send you my slide deck and a few other resources to distribute to your team. And if anyone has any questions, feel free to reach out.
Sure. Yeah. Good.
Thank you very much, everyone.
Thank you. Bye.
Bye.